Come with me now. Come with me now. I'm gonna take you down. Come with me now. I'm gonna show you how. Come with me now.
You know, banks, they charge you money. Sometimes they turn you down for loans. They give you these fees, all this stuff. And, there's a movement about that calls them banksters. Kind of like bankers and gangsters combined. So let's ask this audience, though. How do you buy a home without a banker? Okay, how would you do it? The answer is that you can't. It's actually impossible. Okay, so that's the whole point here, is that we have a financial system that is absolutely necessary for our economy to grow. So we're going to learn about the loanable funds market. Okay, loanable funds, very important. Your assignment is the 4-1 assignment on loanable funds. Just a quick preview. What is it? Well, it includes places like stock exchanges. So think of the stock market. That's where businesses go to raise money. Investment banks, mutual funds, and commercial banks. So to start with, why don't we just think of the loanable funds market in terms of how you and I might use it. Okay, we would typically borrow money to, say, buy a car or a house. Okay, we're going to expand that to mean primarily that businesses borrow money. Okay, that's how we're going to start. All right. By the way, in order for there to be money to borrow, somebody has to save it. So savers put money in the bank, businesses borrow the money and purchase capital. Okay, so think of it this way, kind of a flow chart here. You've got savers, that's us, we save our money. Okay, that's households. We also have, of course, foreign governments or foreign entities in general save their money in the United States. Okay, where do they save it? They save it in banks, or they could purchase bonds or stocks. And then the borrowers are how we're going to start with just firms, but later on we'll reveal that governments also borrow. Okay, so the loanable funds market is just a supply and demand graph. Okay, the pricing and the quantity labels are going to be a little bit different though. Okay, so for the price, we're going to put real interest rates. Okay, we have a supply. Think of the supply as people saving. Okay, so savers make up the supply. Then we have a demand curve. This is going to be the borrowers, but I suppose we could use the D word here for debtors. And then the quantity down here is really going to be savings and investment for now. Okay, you could actually write this. You can put quantity of loanable funds, and you can get away with that. But I want to make sure that we understand in great detail that the loanable funds market is where savers and investors meet. Okay, we save our money, businesses borrow the money to make investments. So it is the savings and the investment. All right, now a couple other notes. The supply of loanable funds will increase or decrease based upon our ability or desire to save. And then the demand curve will shift left and right based upon the ability, or not necessarily just the ability, but just the desire for businesses to purchase investment as far as capital goes. Okay, so this is why this is all necessary. All right, let's say you have a great idea, you want to build a product. Okay, you can't just, just out of your butt start making a product, okay, unless your product is poo. But anyway, let's say you want to build something, and so you have the idea. In order to get the idea going, you got to borrow money. Okay, so that's where we get that. You borrow the money so you can build capital. You can set aside a little bit of that money to pay your employees and so on. So then you begin producing. Once production happens, then you can sell the output and then repay those loans. And so that's basically how the production timeline works as far as borrowing is concerned. Okay, so without the loanable funds market, most of the new businesses you see starting up would never get off the ground. All right, so think of it as just any other market, okay, except this time the good or the service is loanable funds. Okay, The price is the interest rate, but I want to be even more specific. We're going to put real interest rate. And then the quantity is listed as savings and investment. Okay, so you got the supply of loanable funds is people saving their money. The demand is going to be people borrowing the money, so you could put debtors, but they borrow it to make investment. So the demand curve for loanable funds is actually the same thing as the demand curve for investment. All right, so when you save your money, you are the one supplying those funds. Okay, the price you receive for supplying those funds is the interest rate. Okay, as an example, if the interest rate were 3% and you save $500, that means you'll earn $15 over the course of a year that you save that money. Okay, the law of supply is very simple. The quantity of savings will rise when the interest rate rises. Okay, so if interest rates are higher, it gives you more incentive to save your money. Okay, the interest rates are not just your reward for saving; they're also a cost of borrowing. So on the demand side, interest rate is the cost of borrowing. Higher interest rates mean a firm who wants to borrow that money is going to have to pay more to borrow that money. So when should a firm borrow? Well, here's the thing. This piece of equipment here is very expensive. So the only time a firm will actually purchase this is if the interest rate on their loan is less than the expected return on the investment. So for example, if they can expect to earn 5% on the investment and the interest rate is 3%, they'll do it, okay? Because the interest rate would be lower. That means the cost of borrowing the money is less than the reward or the payoff from purchasing the capital and using it in your business. Okay? Here's some more examples. You can look at all of these different things that a firm could borrow money and purchase. ROI just stands for return on investment. Okay? So if they borrow $2 million to renovate a plant, they're going to get a payoff of about 27% of that. So that would be pretty high return on investment. So in the case of interest rates being 18%, the interest rate would be lower, therefore they could do that. Okay. If interest rates were 18% though, this wouldn't pay off, this wouldn't pay off, and neither would this, because the returns on those investments are lower than the interest rate. Okay. So when interest rates drop, what do you think happens to investment? It's going to increase. Now, let me see if I can draw a larger. No, that's the wrong color. Hang on. Now, whoa, go back. If you look, these various things that could be purchased or invested in, they create a downsloping curve. So that is the demand for investment. Okay? So the demand for investment is the exact same thing as the demand for loanable funds. So if you keep those things married together like that, this will be a lot easier to think about. All right, so a quick summary. All right, the supply of loanable funds comes from people saving money. The interest rate is a reward for saving. The demand for loanable funds comes from people wanting to borrow money. Very simple. Okay, so now we're going to look at the factors that shift the supply of loanable funds. Okay, first of all, we need to understand the difference between movement along a supply curve and shift in the supply curve. Okay, the movement along the supply curve is just when the interest rate changes, we will change the quantity of loanable funds that we supply. So it's kind of like going all the way back to the difference between quantity supplied and supply. Okay, now let's leave that alone because that's not going to be as important for us. How about this question though? Do you spend more money when your income rises? Here's another one. Do you also save more money when your income rises? The answer to both of those is yes. Okay, so those are the things that will shift our supply of loanable funds. Okay, changes in income and wealth. Okay, as your income rises, you're going to save more of your income. Change in time preferences. We're going to discuss that in detail in a second. And then we have this thing called consumption smoothing, and we're going to talk about that in a second as well. So you need to be aware of these three factors that will shift the supply of loanable funds. And primarily, we'll probably be considering the changes in income and wealth. Those are the biggies. All right, so income and wealth go like this. First, let's label our thing. We got real interest rates, you got the supply, you got the demand, and then you have savings and investment. Okay? So, increases in income generally increase savings. So all things being equal, ceteris paribus, if your income goes up, you're going to spend more money, but you also have more left over to save. So increase in income is going to lead to an increase in the supply of loanable funds. Okay? Now note what happens to the interest rates. Interest rates will fall when we save more money. Okay? Does that make sense? Now note this. People in other countries also like to save their money in the United States. Now, this says that foreigners will save their money here when interest rates are higher. But that's not the only reason. And in fact, in many parts of the world, interest rates are higher than the U.S., but they prefer to put them here. Why? Because the U.S. is safe. Okay? Boom. Time preferences. Okay, so what does that mean? Time preferences just refers to how long you can wait to get something. Okay? So, when do we want things? The answer is now. If you said anything else, you know that's wrong. Okay? People generally prefer goods sooner than later, and funds are no different. Okay? Do you want $50 now, or do you want $50 later? Okay? We always want things now. And so that results in a need to pay somebody for their funds if they can't have them right now. Okay, so loans are paid back at a later date. That means somebody is putting their money out there that they can't have right now. So to compensate, we have to pay someone to borrow them. Okay, the longer the loan period, the higher the payment. Now, time preferences are not uniform across individuals and societies. So if people are very impatient, okay, they want now, and they will save less. I mean, this actually, have you ever heard of, let's see, money burning a hole in your pocket? Okay, what that's referring to is your desire to spend that money. Okay, if you have increased time preferences, that means you want to spend your money now, and you will save less of it. If you have decreased time preferences, that means you'll save more. Okay, hope that makes sense to you. There's an application here for college, but I don't think we need to really go into that, so I'm going to leave that alone. Okay. The next thing we want to talk about is consumption smoothing. Okay. You may not believe this, but when you're young, you're actually supposed to borrow money. At least that's the way it works out. Okay. So young students and elderly retirees don't work, but they still spend money, don't they? Okay. So here's how it works. In your early life, your income is just beginning to grow. Okay, so you have relatively low income in early life. Your age through, say, the age of 25. Okay, then you enter your prime earning years. This is probably 35 to 55, maybe. Okay, and that's when your income reaches a peak, and then it starts to go down a little bit because you'll end up working less, or maybe you'll semi-retire, things like that. And then later in life, say around 70, that's when you retire and your income goes way down. Okay? But during that same lifetime span, your consumption spending doesn't change as much. Okay? Early in life, you're gonna borrow money to make up for your shortfall between your income and your spending. Your prime earning years, you're actually going to be saving more money. And then as you get later in life, you're going to start spending those savings. Okay? So what the application we would add to this is this. If most of our population were in this group here, that means we are saving less. So there'd be less supply of loanable funds. Or if most of our population is in this category, then there's going to be an increase in loanable funds, the supply that is. And then on another note, if most of our population is old, then there's going to be a decrease in savings. So decrease in savings in this area, increase in savings here, and then decrease in savings here. So that will all affect the loanable funds market and therefore interest rates. Okay? So let's go through the factors that impact the supply of loanable funds. Our income and wealth. Okay? If we have higher income, by the way, let's label this. We always have to label everything. Savings and investment and real interest rates. So if we have an increase in income and wealth, there's going to be an increase in the supply of loanable funds. Or if there's decreases in time preference, then that'll increase the supply of loanable funds. Or as more people are in midlife and therefore in their prime earning years, savings is higher, that would all increase the supply of loanable funds. If, on the other hand, our income goes down, like in a recession, we'll have a decrease in the supply of loanable funds. Or if we're just a more impatient society and we need things now, we're going to save less. Okay, so that would be a decrease in the supply of loanable funds. Or if fewer people are in midlife, that means either older or younger, then there's going to be a lower supply of loanable funds. Okay, just as an aside here, you can note this is how our savings rate has basically fallen over the last, let's see, what about here? We had a peak at 10.9%, and ever since then it's been on a downward trajectory. Now, right in here, you can imagine what caused that. That is the Great Recession. So incomes were lower, therefore there's going to be less savings. Okay. Now let's look at the demand for loanable funds. The demand for loanable funds is made up of entities who want to borrow. Okay. We're going to begin looking at how firms borrow money. So in this case, here's a McDonald's. This is I don't know if that's a stock certificate or a bond. I don't remember and I can't read it. But anyway, it doesn't matter. Bonds or stocks, those are ways that companies can borrow money. Okay. Now, stocks is not actually borrowing though, so I don't want to confuse you there. But governments also borrow. Okay. Now, here's the thing though. Borrowing's not necessarily bad. Okay. Borrowing has to occur in order for businesses to build capital. Okay. They have to do that before they can produce any goods. Okay, so the factors that will shift the demand for loanable funds, let's label this graph again, because you always have to practice this, because you will have to draw it. Okay, movement along the demand curve, this is just caused by changes in the interest rate, so that makes sense. Shift in the demand curve is caused by various things. Could be changes in the productivity of capital. Okay, if these robots that are currently building cars, if they become more and more productive, businesses have a greater incentive to purchase that capital. Okay, so the changes in the productivity of capital will increase the demand for those loanable funds. Okay, or changes in investor confidence. All that is saying is whether businesses feel like the economy is growing, then they're going to increase their purchase of investment capital. If, however, they think the economy is doing poorly, they're going to decrease investment in capital. Okay, and then changes in government borrowing. Okay, we're going to talk about that when we cover taxes and government spending. But just note, in the last few years, at least, say the last 15, governments have borrowed more and more and more, so it becomes a bigger issue. Okay, and then finally, changes in consumer debt. We as consumers, we buy cars, we buy houses, and so and you guys are going to be borrowing for college probably, so student loans, those are all consumer debt. All right, so in greater detail, the factors that affect the demand for loanable funds, the productivity of capital. Businesses probably are not going to borrow money to buy screwdrivers. Okay, they're just not very productive. However, they might borrow money to purchase a capital good that is more productive. Okay, computers are more productive today than they were 20 years ago. Okay, because 20 years ago they just weren't as productive. I mean, they were basically glorified typewriters at that point. Okay, so factors that affect the demand for loanable funds will continue with investor confidence. Okay, if businesses feel the economy is strong, they're not going to be afraid to build that new factory, and so they'll borrow the money to do it. No big deal. Okay. Now, a couple other notes. We need to make sure we understand that in the loanable funds market, in equilibrium, savings will always equal investment. Okay? And the reason is because the supply of loanable funds is savings, and the demand for loanable funds is investment. And so in equilibrium, at this point, there's an equal amount of savings and an equal amount of investment at the 5% interest rate. Okay? So every dollar borrowed absolutely requires a dollar saved. So make sure you have that noted. A decline in investor confidence. Okay, this tends to reduce the amount of capital formation. So think in terms of the recession. Okay, the recession of 2008 and 9. You will see on the graph I'm about to show you how investment declined. Okay, here we have two recessions. We have the one from 2001. Okay, during that period, investment fell. The red line is investment spending. Okay, it's nothing else. It's just investment spending, and then it ticked back up until it peaked right around here. That's when the economy started showing some warning signs, and then right here, recession, boom, much less investment spending. Okay, and so how would that look on this graph? On the loanable funds market graph, we would just see a decrease in the demand for loanable funds in 2008 in response to the recession. Okay, businesses aren't going to build factories in the middle of a recession. Okay, so the future of loanable funds, well, our savings have dropped over the past 30 years. So, that would tend to lead us to believe that the supply of loanable funds isn't going to be increasing anytime soon. Okay. However, we do have this. Okay. You hear that we owe China tons of money, right? Well, the reason we do is because China and entities in China have decided that saving in the United States is the safest place to save their money. And so you'll see more of that probably. What about when baby boomers start retiring? Okay, when they start retiring, and they've started, by the way, 10,000 per day retire. If we have more old people, there's going to be less supply of loanable funds because they're going to be dissaving. Okay, so concluding, the loanable funds market can be conveyed through the mechanism of supply and demand. Okay, this is a very important macroeconomic topic. Investment is not the purchase of stocks and bonds. It is the purchase of capital. We always have to remember that. Okay? And if we don't have an efficient and stable loanable funds market, firms can't get loans. That means they can't invest in new technology, new capital, new machines, factories, and so on, which means economic growth will stop. So please don't forget, investment is what gives us GDP growth. Okay? You have to have investment in order to have GDP growth. All right, let's practice what we know. You can pause the video and ponder these questions and then answer them on your own. So where does the supply of funds in the loanable funds market come from? Why, it comes from consumers, of course. Okay? The interest rate. This can be thought of as, well, you know what? There's a couple of good answers on here, really. It could be the rate at which banks loan funds. I mean, that's possible. But a more all-inclusive answer is D. Okay? In the basic consumption smoothing model, remember that? That means when we're young, we borrow money to increase our consumption. When we're in midlife making lots of money, we save more of our income. And then when we're old, we start spending that savings. So, when are consumers dissaving? Dissaving means that you're spending your savings, so that happens late in life. Okay? How will an increase in time preferences affect the loanable funds market? Well, if there's an increase in time preference, that means we want it now. Okay? So there's going to be a decrease in the supply of loanable funds because we'll save less so we can buy things. Okay? What is true about equilibrium in the market for loanable funds? We talked about this. Savings always equals investment. Okay? Here's some pondering questions. These would be good examples of questions where you have to draw a graph. So a good short free response type question. If Americans decrease their savings, what will happen to interest rates? Well, they'll increase. Why? Because the supply of loanable funds would decrease. And so you have higher interest rates. Okay? Millennials, they are the largest American demographic. Did y'all know that? If they continue to have difficulty in this economy, what will happen to interest rates? They're going to increase. Why? Because even if their income's low, people are still going to spend. And so there will be less savings. Or you could actually throw this up here. There could be greater demand for loanable funds. Either way, you're going to have higher interest rates. If the government continues to deficit spend, what will happen to interest rates? Well, they're going to increase. Why? Because when governments spend more than their tax revenues, they have to borrow the difference. Okay, that's what we mean by deficit spend. And so the borrowing will increase the demand for loanable funds. If businesses lose confidence in the profitability of increased investment, interest rates will, well, if they lose confidence, that means they don't want to borrow money and invest. Therefore, interest rates would decrease because there will be less demand for loanable funds. Okay? Tricky one? I don't think it's really tricky. If Americans' incomes fall, interest rates will increase. Why? Because they'll decrease their savings. Okay? Anytime your income goes down, you cannot save as much money. And finally, maybe finally, I don't remember. If China continues to put money in our financial markets, interest rates will decrease. Whoops, it was the last one. The reason? Because if China puts their money here, there's going to be an increase in the supply of loanable funds, therefore lower interest rates. All right, now let's go in and look at your homework assignment so we can be sure that we understand where that is. We are now in Unit 4, Financial Markets. This will be your homework assignment, the Unit 4, Lesson 1 on Loanable Funds Market. So it's right here. Blah, 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 blah. Here it is, Unit 4, Lesson 1, Loanable Funds Market. So it's this assignment. Make sure you get in there and do it, okay? By the way, there is, it looks like, another example of the Loanable Funds Market if you don't like my video. All right, you guys have a blast.